Keon, I see your chat. Appreciate you, man.
What's up?
Yeah, let me do it.
Let's do it. Good afternoon. This is Jesse with the Cash Compound. Jonah's going to be joining me in office today for our Ask Me Anything. It's Thursday. It's 3:30 Eastern when we host this Ask Me Anything. This is about whole life insurance, infinite banking, saving and spending your money at the same time. We're going to be getting on another platform. We're on a Zoom. We've got a Zoom where we can share visuals, which is pretty cool. We can see comments there and interact a little more personably. We're on YouTube, where we will also address your questions that you put in the chat. And we typically get on a social media platform, TikTok for us. That's what Jonah's pulling up for us right now. So thanks for being here. Let us know where you are seeing us from. I hail from North Carolina, but of course I'm in studio today, South Carolina. Jonah, South Carolina, man.
South Carolina, yeah. Been here the longest, so I claim it.
It's where he lives. It's where he works. It's where he gets his hair cut and everything.
That is correct.
We were talking about haircuts before we went live.
Okay, this is, if you are watching out there, if you're on Zoom, if you're on YouTube right now while we get everything set up, this is an Ask Me Anything hour. Keon, appreciate you, man. Naples, Florida. I like Florida, actually. I met my wife in Florida, so I have a special place in my heart for Clearwater, Florida.
Sure.
But this is an Ask Me Anything hour. So what we are interested in you doing is asking us anything, right? So type your questions in the chat. If you're in our Zoom audience, that's like the special place to be because you can interact with us. We're obviously on Zoom as well, so you can unmute yourself. You can say something. You can put it in the chat. You can show your camera if you want to, that sort of thing.
Yep.
So that'll be really fun. But the whole idea here is to ask questions so we can answer them. Okay, I have a TikTok profile pulled up for us.
Love it. Yeah, these are the kinds of things that we do on the regular that were not going on when you and I got started saving and spending our money years ago. And these are the types of things that can really speed up your learning curve, can really collapse time frames on your progress, both in vetting the concept, understanding it, and then, of course, implementing it. So thanks for being here, everybody.
That's right. Another Zoom attendee. Hello, Elena. Thanks for joining us to our Ask Me Anything. So if you would right now, put in the chat where you're zooming in from or where you're watching from while we get everything set up. And then normally Jeremiah's here doing this, not me.
Yep.
And so what that means is he knows the intricacies of the social medias and the phones better than I do. So...
Gotcha. Well, that's better than me because you had the computer in front of you for our Zoom audience. I'm here trying to peck at the screen.
That was accurate.
Ignoring the keyboard and the mouse.
That was accurate. So. Winston-Salem, North Carolina for Elena. What do you know about Winston-Salem?
That it's in North Carolina towards the middle where it's flat. I like mountains, Elena, but it's a different area out there. It's a popping area.
Okay, I'm going to put this right in the middle, maybe, or at an angle that can, you know what? I might let you handle the phone.
It's a horrible idea.
And I'll do the computers and whatnot. Okay, for those of you just tuning in, this is our Ask Me Anything hour. What we are interested in is your questions and concerns. If you have them, please put them in the chat. What we want to do is answer them. We can dive into detail. We can give you visuals. We can answer your questions specifically. This hour is catered toward our Zoom audience. Zoom audience, thank you for being here. So if you guys have questions, you guys are going to get the preferential treatment because you joined us on the Zoom. We are also live on some of the other social media platforms, but we're catering to the Zoom most specifically. So that's what we want to do. And I think officially... we are live everywhere. Now, If you don't ask questions, I guess you're just going to have to hear us talk for a while about infinite banking, though. Right?
Awkward. Yeah, about infinite banking.
Very cool. Well, until we get a question, we've got the YouTube chat up. We've now got TikTok over here. What's up, TikTok? We've got Zoom going. Until we get a question, I've got something that I'd love to kind of share with you. I want your opinion on it, if that's okay.
Let's hear it.
Okay, so my first kind of comment here is most recently I was I was going to do a video, put it out on YouTube about infinite banking and Dave Ramsey's very famous saying, which is buy term and invest the difference.
Okay.
So I was going to put out a YouTube video on that, and I started thinking about the phrase buy term and invest the difference. And I started thinking, why don't the people who like that idea, I'm not saying it's a bad idea, but why not the people who like that idea? Why don't they actually apply that idea to more than just that area of life?
Such as, give me an example.
Like the idea is buy term because it's less expensive, invest the difference. Just go invest the difference. So why not always get rides, invest the difference? Right?
Okay.
Why not rent always, invest the difference?
Okay.
Right?
Yeah.
I mean, is this not the same? Is this not am I off base by saying that's the same idea that he's saying? Is it not? Like, why
In
did
those other
like
areas,
the invest the difference? I'm wondering, like, how did the life insurance sneak into that, like, saying in that phrase? Like, why would it be life insurance? Buy term, invest, always get Netflix, invest the difference. Like, it just kind of confused me as I started thinking about it. Isn't that interesting?
It is.
Because I'm like, all he's saying is there's two things that are equivalent. Get the cheaper one, invest the difference. That's all he's saying. And I'm going, well, then apply that to
I
other.
like the renting example.
Yeah,
I like the renting.
I'm like,
example.
well, then
Rent
apply
for the
that
rest
to
of your life.
apply that to other stuff.
Okay.
I'm like, why only life insurance does get that application? Like, that doesn't make sense. Other things should get the application then.
And not only that, but term in and of itself literally can't last you for your lifetime, so it will go away.
Right.
It will go away.
Isn't that interesting? I was just thinking about it as I went to make a YouTube video about it. I was like, I got to think about this so I can make sure that, in YouTube videos, you got to be kind of fun and exciting. You need some visuals sometimes, or maybe an analogy, some B-roll coming in with cars and houses. And I was like, man, I'm just thinking this through, and I'm going, why would the invest the difference idea pinpoint? Why would he come after life insurance like that? Like, why not a different area? Here's my thought. I just felt like I could start there.
Well, and I've listened even to some stories of term-only companies that are out there, and they'll have some backstory right behind that, and it typically dates back perhaps to that 80s time where people were trying to unbundle, to use their language. They were trying to unbundle life insurance and savings and what they were considering as investments and whatnot.
I like it. Cool.
It's
We've got our first question from Zoom. Actually, let me go over here to the phone. The phone's beeping at us to say people can't hear us, I think. Let me play with some settings. But we'll take Elena's question right out of the Zoom chat, and we'll jump into our first question here in the Ask Me Anything. Can you see it?
Yeah, I can see it.
Cool.
I'll handle the question. So Elena's asking, if I come into a settlement, can I put $9,000 in, and that would pay the first 2 years? Great question. Couple of moving parts. So the most or the longest amount of time that you could pay for in a policy is 1 year, or at least for a banking style policy. There is actually such a thing as one-time pay, but let's table that for right now. You're going to pay once a year, twice a year, 4 times a year, meaning quarterly payments, or once a month are those typical modes, okay? So the most you could regularly pay for is 1 year. But this realistic example that you're giving of some windfall from somewhere, so very applicable, no matter whether your policy's been built for monthly or annual regular premium payments. If you got extra coming in, just pay that as extra premium into the policy if you want. Now, could you carve out a certain amount and let it also pay for that year's premium if you have enough? Sure, you can. Just hold it in the checking account or savings account until it's time for it to go in, pay your regular premium. And if you want to pay some extra because you have extra, pay the extra. I would actually encourage you to, Elena, when there's some windfall, doesn't matter if it's a Christmas bonus, doesn't matter if it's a tax refund, doesn't matter if it's an inheritance, doesn't matter if it's a settlement, no matter what it is, the way we build our policies is it's going to be able to accommodate extra. And we anticipate that you're going to want to pay extra the more you understand this concept. So you can definitely pay extra.
I love it. I'll give you my version of the answer too, Elena, if you like. I used to, way back when, work inside of car and auto insurance.
Mm-hmm.
So I've got, every time I give answers, I normally relate it to the car and the auto insurance because I feel like people relate to that really well.
They know it.
So here's how I'd answer the questions. If you really did this afternoon, call your car insurance company, State Farm, Allstate, Progressive, Geico, and you said, I want to pay you for the next 2 years, would they take it?
No, they don't.
They don't take it, actually, believe it or not. They'll let you pay for the current year that you're in all the way up to wherever that year is, but they won't take any extra over that. They don't actually even take it, which is a weird thing.
I hate
but
it that some won't even let you pay more than 6 months.
6 months, right? Well, it's because they write their policies on that frequency, 6-month policy, and then it renews,
right.
Or a 1-year policy, and then it renews. So you can pay the term that you're in, but you can't actually continue and pay on. So it's the same thing here. Obviously, we use whole life policies for the idea of the infinite banking concept, but you still have insurance kind of rules and regulations going on. Yep. So you got to pay attention to them. So, okay, for all of those here or here or here, please put your questions in the chat. We want to make sure that we answer them. This is our Ask Me Anything hour where we kind of go through them. I've got a question over here from TikTok, but I've also got another follow-up from Elena. Let's do Elena first, since she's in our Zoom audience, if you will. You see that? How long does it take to be able to have the cash accumulation pay the premiums?
Oh, neat. That's a good question. Yeah. So my take on that is it depends. It depends on how old the policy is, at what rate you've been capitalizing in the policy. Really, probably how much banking you've done with the policy is going to accelerate that time frame. That's going to collapse time frames. The more you bank with a policy, the more that you pay extra premium into the policy, the more that you use capital from the policy to go out and do productive things, and then that allows you to recapture more into this system. The sooner you can do that you're asking me about, but to be able to give you a number, Elena, or anybody a number, I can't tell you that number. That's something that we could look at together and that we actually do look at together in our process. Even when you're applying for a policy and you've been approved and we're doing a policy walkthrough, that's something that we can show you and say, well, hey, you see what you're qualified for here. This is the policy that you could accept. It's been built for banking, but it's a big if you only left it on autopilot, and if you only paid these minimums, here's where the policy is so efficient and productive that in and of itself, its own growth could cover ongoing premiums from X date forward. And then, of course, if you pay extra like you've already been asking about, and if you actually bank with the policy, that can happen so much sooner.
I love it. Good answer. I won't even follow that one up. That was good.
Oh, come on.
Cool. She also said it makes sense. So that's one of the reasons.
Beautiful.
I think she's good to go.
But I appreciate it when you give another perspective, or Jadu does too. I mean, Russ, like when you get the benefit of two people's perspective or their wording on the same, it's a good thing.
Cool. Okay, we've got a question from TikTok. We've also got a question from YouTube. Let's go TikTok. I think he was first in here.
Yep.
So this is Joe Laz4. Joe Laz4 is asking, why has Mass Mutual, this insurance company, said that you cannot market as Be Your Own Bank or Infinite Banking? Any ideas? Do you know the answer? I do know the answer, or I have an opinion on the answer.
Right. I feel like there could be more than one answer to it, meaning practically speaking versus like a philosophical answer, I guess. Sure. Give yours first this time.
Yeah, so Joe, this is for you if you're still out there watching on the TikTok Live. Okay, so what's going on is Mass Mutual is a very strong old company. In fact, if you know anything about insurance, Mass Mutual would be considered one of the big four. Mm-hmm. There's 4 big companies out there. You could Google the big 4. You're going to see Mass Mutual's name pop up, right? Here's the thing. Mass Mutual's been around for a very, 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 very long time. Infinite banking has been around for a very, 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 very long time, but infinite banking is becoming a little bit more mainstream these days. And so what that means is that when a person is helping people get infinite banking policies, like let's pretend that you're an infinite banking certified practitioner like I am, and you want to go help hundreds of people get infinite banking policies, and then all of a sudden hundreds of people are calling in to Mass Mutual trying to take loans, trying to repay loans, and Mass Mutual wasn't designed or set up, their customer service wasn't set up to handle that, is what's going on. So imagine this. Like, again, I'll relate it back to car insurance and home insurance. So, Jesse, this is a real question for you. Who are you using for car insurance these days?
Currently, Progressive.
Progressive. When is the last time you called them?
Physically called them?
Physically, when is the last time you called your
never
car?
have spoken with them.
You may never have
did it
spoken with
online.
Progressive. So imagine that somebody comes in, sells a bunch of car insurance policies, and those people call every 2 days. What does that do to Progressive's phone line, to their customer service, to their, right? Does that make sense?
That's the practical answer.
That doesn't, they're not set up for that, actually. And so that's what actually happened with Mass Mutual. Mass Mutual's got big time companies. So they got now all these agents who want to help people do infinite banking. They're putting all these policies with Mass Mutual. All of a sudden, all these people are taking loans, repaying or not repaying, repaying later. They're calling. They're all these questions that have to do with the policies that they sell. Yeah, but Mass Mutual was like, either we have to completely revamp things in order to handle this, or we need to tell people to go back to the regular insurance because that's how we built everything, right? And that's a little bit, that's my perspective. There's more, but that's a little bit on the answer. That was for Joe Laz 4. Cool.
Yeah, I love it.
Cool. Let's jump up. I see some more questions coming in. 7-figure virtual agency, Mass Mutual, crying out loud face, not so good.
There's something to be said about working with companies that are aware of infinite banking and even favorable towards infinite banking.
That's right. Cool. Okay, we had a YouTube question. This is from Jake Doster. All you.
Oh, yeah. Jake and I were texting earlier today. Okay, so let's see. How does the life value with multiple policies, how does it work? Okay, how does the life value, maybe you're meaning how does the cash value work with multiple policies? Let me know. And then the second part of your question, you're saying not sure you will understand the question completely. I'm in my big brown truck and you're working. Yeah, I got you. Multiple policies. I'm not sure how to take the question, Jake.
I think I know what he's asking, but I'm not sure if he's talking about cash value or economic life value. So maybe we should just answer both.
Yeah. Okay. So there should be a natural progression over time, right? Like I got my first policy in 2016, started paying off debt and recapturing money. It soon became obvious to us that we wanted to do more of that and faster, right? So we got a policy on my wife. That was a brand new policy. It was a brand new application. It was a brand new person getting a policy, right? And it meant that we were dedicating more of our cash flow to premiums to create cash value, to be able to leverage, go out and do things bigger, faster, sooner, etc. Right? So we increase our cash value by paying more premiums. Premium is always the solution, right? It's always the solution. Okay, and now we're getting a follow-up, so you're still there. That's great. That's great. So there was just a natural growth, a natural progression of our system over time, and that meant that we could do more sooner. All right, so let's see what else you're saying. So
can't be insured more than life. I'm not sure what the last word is. So that makes me think he's talking about your economic life value.
Okay.
Can I jump into that?
Yeah,
one
let's
really
talk
quick?
about that aspect.
Okay, cool. So Jake, I think this is what you're saying. You're saying that right now, sitting in this chair on September 12th, I am a 32-year-old male. I have a family.
man.
Thank you. Thank you. I've got a family. I'm married. I got a wife. I got 3 kids. I work. I'm the sole breadwinner in my home. And so when I apply for life insurance, the insurance company asks lots of questions, makes me pee in a cup, but then they determine my economic life value.
Right.
Now, if you need help determining your economic life value, there is a pretty easy way to do it. You can actually take how much you make now and multiply gross, and multiply it by how many years you plan on being around. That's a real rudimentary way to do it. So, right, let's imagine that I make $100,000. I'm 32. Maybe I'm planning on being around till 85. So you take 100,000, you multiply that by 53 years. Does that make sense? Okay, so that's a bunch of money, right?
Yep.
A lot of money. Okay, that is my economic life value, and that is how much you can be insured for, right? Now, when I bought my very first infinite banking policy, I actually decided to pick the premium. I wanted to pick the cost, which means the insurance company got to pick the death benefit, right? Traditional insurance, you know this, everybody knows this. Traditional insurance, you walk into that office and you pick the death benefit. You say, hey, I want $1 million after I'm gone. Hey, I want $500,000 after I'm gone. And if you pick the death benefit, then the insurance company gets to adjust cost.
Yep. And they
right?
tell you.
Right, but we reverse it. So I picked cost. No. This policy will cost me this, And they said, fine, but we get to adjust death benefit then, right? So all good. So I may not be insured, even though I'm worth my economic life value. Let's call this $5 million is what I'm worth. Even though I'm worth that, I didn't actually buy that with my very first infinite banking policy. Not even close. I didn't buy it. And because I didn't buy it, I'm allowed to have as many more policies as I want until I hit $5 million total on the death benefit.
Yep.
Insurance companies talk also. So if you've got one policy with company A and you get a new policy with company B and think I beat the system because they're not going to know, you're wrong. They absolutely talk to each other.
Through work, anything you have through the military, it all counts.
It all
towards that
counts,
number.
right? It's the same. Here's car insurance back. It's the same as the car insurance. If you've got Progressive and you call Geico right now, they can tell you that you've got Progressive.
Right.
Can't they?
Yes.
They know. Right? It's the same thing with the life insurance. And so that's a little bit of how you can have more than one policy with the economic life value.
I love it. I actually had somebody go through the process recently, and we had a good conversation because they, like you and I, with their first policy, they focused on the amount of premium they wanted to pay. It got them a certain amount of death benefit, but the insurance company went ahead and told us, hey, this person, based on their rating, they'd actually qualify for another, 1.5 million or whatever it was. And it's a good conversation to be able to have with Jake or anybody else like that individual.
Jake's got a follow-up here. I'm going to be right back.
Yeah, okay. Let's see your follow-up. So the economic life value is up to how long you may live, how long you work. Essentially, you with two data points, you can kind of figure out how much life insurance you can qualify for. So again, your age is one of those factors, and your gross annual income is one of those factors. So at whatever age you are, so let's say in your 20s and 30s, you could qualify for 30 times whatever your gross annual income is. And when you're in your 40s, you could qualify for 20 times. And then 50s and beyond, you could qualify for, 20, 15, maybe 5 times. Right? So the older you get, the less multiples that you can qualify for. But again, typically speaking, most people earn more later in life as well. So hopefully that's helpful. Age and your gross annual income are both factors in helping you figure that out. Man, we're getting some good questions. Appreciate it. Keep putting some more in there, Jake. If you need more answers, Elena, same to you, everybody else in our Zoom. Let me turn over to the TikTok. I feel like it's not getting... What's up, Richard? See you on the TikTok. We're doing great. Hope you are. What questions do you guys have about infinite banking, whole life insurance, saving and spending money at the same time? Moving lively. Okay, Mimi, she's next on YouTube. Hi, guys. What's up, Mimi? What is the difference between the companies that you use? Good question. At a big level, they're going to all hit the same metrics. All right. So here's our standard. Our standard is we want to use whole life insurance from mutual life insurance companies. That's a type of a company, not a particular company, a type of a company. Mutual life insurance companies that pay dividends and have paid dividends for a minimum of 100 consecutive years. Okay. So we want to use mutual insurance companies that participate, meaning they share those dividends that they earn with the policy owners, and we want their whole life insurance products. So I could give you the names. Of course, it's going to be based off of different factors, right? Like perhaps what state you're from and how we're going to be building the policy, because we custom build our policies based on the client, based on the individual, but those are the types of companies that we want to use. Good question. Let me make the circle to all these different platforms. See what the next questions are. Let's see. Okay. Let's go back to Richard. Richard commented a second ago. Here's the next question. I was paying $80 a month for a $25,000 death benefit policy. Okay. Was I paying too much? So that's a plain Jane life insurance, basically just a burial type policy, a final expense type policy is what that sounds like. So as far as were you paying too much? I mean, that's a good traditional question about insurance, right? So probably not. That's probably a good price for what you were getting, right? But here what we're doing is something really, really different. Like Jonah was saying a second ago, here We are intentionally trying to pay significant premiums, not find out how little we can pay, but we're trying to find out how much we can reasonably pay, but significant premiums into policies that we're going to own and control and use for banking in our lives, right? So it's just a completely different paradigm to go from, well, okay, you traditionally get life insurance for that death benefit, for that coverage, for that protection, and that's good. And everybody should have adequate protection, in my opinion, right? We were just talking about human life value a second ago with Jake. I think we should be insured for however much we can be insured for. And here's why I think that. If you do have car insurance, do you only insure half of your car? Do you only insure half of the value of your car? What about your home? If you're paying home insurance and it burnt down in a fire, would you only want to receive half of the money that represented the value of the home? No, we're going to insure the full car, the full home. So why wouldn't we at least over time do that with our lives? I believe that we're our greatest asset. We should be insuring ourselves to the maximum. So it's a very different way of using life insurance than the traditional route of just getting the protection. We're going to have the protection, but we're also going to be building a system, a capital where we can be saving our money, right? We're paying significant premiums, so we're saving money here where there's compounding, where there's growth, dividends, access, no penalties, all that kind of stuff, plus maintaining access to use that for the things that we're going to do in life. So it comes with that guaranteed death benefit, but it also has a lot of living benefits when a policy is built that way and then used the way that we're teaching people. I hope that's helpful. Yeah, you're saying, okay, cool. You're welcome, Richard. Appreciate you being here. Ask any other questions. Love it. Okay. Another question from our Zoom group. This one's got details. This one's got details. Let me see if I can scroll up to get to the start of this. I'm trying to figure out how to scroll up. That's a good question, and I'm seeing part of it. I'm going to have to come back to it. Hang in there. The tech is a challenge for me. Okay. Mimi giving a heart on the comment. Appreciate that. Richard, if you had any follow-ups, get that to me. I'm trying to get to the Zoom question here. This one has some numbers and an example. Jonah, if you can help me scroll up or whatever I can to see that full detailed question that we're getting right there. Oh, you just did something right there even that started to move it. But I want to get to it.
Yeah, here we go. This is from Elena in the chat. So we got that one. Here we go. When's, did you already read it?
No, I couldn't see the beginning of it.
Here we go. When's the best time to start using the policy? For example, some say don't touch it for the first 3-ish years. However, if my policy is worth $6,000 after the first year, can I finance something for $4,500, for example, and pay it back and still have it grow? Or do I actually wait 3 years, have it worth $18,000 and finance for a larger amount? It's a really good question.
Sounds like she knows the answer, but it's a good one to talk through because
Yeah,
there
it
are
is.
those people out there that say, oh, well, you can't do anything with whole life or you shouldn't do anything with whole life until year X, Y, or Z. So very practical.
Yep. Cool. You want me to jump in?
Yeah, go ahead.
Sure. Okay. So, Elena, the answer to your question is we are going to encourage you to use your policy ASAP, as soon as possible. Right?
I did.
We want you to get into the habit of becoming your own banker, using the policy.
Not becoming your own waiter.
Yeah. Don't. So,
Wait 3 years.
so you're not like incorrect in saying, can I wait?
Sure.
Of course you can wait. You can accumulate, but why wait? Like in your example, like if the cash value sitting in your policy, let's use it to go finance something. And here's the biggest piece to remember, Elena. When you take loans and then repay those loans and add interest or paid up additions to your policy, that actually grows your policy. When I say grow, that can be confusing, sure. So let me be more down to earth. Your policy's cash value gets bigger. Therefore, you actually will have more next year, the year after, 3 years down the road. So waiting might mean that your policy is worth $18,000 3 years later, like in your example, possibly, right? Just depending on your policy size and all that.
But it could be that, sure.
But using your policy for the last 3 years appropriately, banking with it, guarantees that your policy will be larger than 18,000 in that third year. So I suggest we use it. So not only is it larger than the 18, or this is just the example numbers, right?
Yeah.
But not only is it larger than the 18, we used it for 3 years. Like we bought stuff. We paid stuff off.
So you got the money and the stuff.
You get the money and the stuff.
And
so
the money's bigger because you did use it.
Exactly. So I'd encourage you to absolutely use it. It's a very good question, though. Okay, Keon, anything? We want to give preferential treatment here to you in the chat. So if you got something, throw it in.
Mm-hmm.
I did see a couple questions. Well, we've got a YouTube question here.
I think I'm caught up on YouTube.
Mimi's question on the bottom.
Yeah, Mimi already joined us, and I got her a question.
Thanks for asking,
there.
Mimi. We've got some TikTok questions here. So I've got a Richard Serrano question.
Yep, answered that one.
We
but
answered
the one
that one?
right below it.
Okay, so
haven't
this
answered
is
that one.
JH12776. He asks, what will be qualifying factors for a policy besides age and income?
It's a good question.
Sure. There's a really big one that you didn't put in, but you might already know that one, which is health. Health is a humongous factor, right? Sometimes when we do like a live presentation introducing the infinite banking concept, I say things like, imagine a 20-year-old and a 60-year-old both walk into a life insurance store and they both try to get life insurance. Which one gets more?
The 20-year-old.
That's the 20-year-old. So that's age, JH12776, right? And then sometimes I say, well, imagine there's a 40-year-old non-smoker and a 40-year-old smoker. Who gets more life insurance?
Non-smoker.
The non-smoker. That's the health portion of it, actually. So qualifying factors for a policy, I'm not sure if I'm going to throw income into that ring and say there's like a minimum level of income to get life insurance. I'm not sure I'm going to say that.
Right. And that makes sense. I understand.
JH. I'm not sure I'm going to say income. I'm going to say health and age.
I'm sure he's probably mentioning income because we were having that conversation about human life value and what's your income and things like that.
Okay, I can get that, but okay, cool. He said, I'm learning. Thanks.
Love it.
Okay, I think we've got one right above it, which is Rudy. What's up, Rudy? Thanks for asking a question. Okay, so Rudy says first, how does this work? Explain. And then says, interest does not go to the policyholder, goes to the insurance company. But if that's incorrect, please help explain. I love that, actually. That's a really, 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 really good point, Rudy. We should talk about that.
Let's do it. Yeah. So you're right, and there's also more to it. Okay. So you're right. If you take a policy loan from the general fund, from the insurance company, because you're a part owner, right? Being a policy owner, they're going to tell you, hey, here's the interest rate, right? The only two questions they'll ask you for the policy loan is how much of what's available do you want us to send to you? Do you want a check in the mail or direct deposit? You answer those two questions, the money's sent to you, and yes, there's going to be an interest rate for that loan, right? And when you pay that back, it does go to the insurance company. Now, why I love that is because I am a part owner of that company by being a policy holder. These companies have been paying dividends for over 100 years. So I'm very interested in the overall profitability of our insurance companies, right? Because I like these dividends that grow and compound in our policy as well. So you're right, 100%. When you pay back a policy loan, the interest goes to the insurance company. There's another layer to this, though, right? If the insurance company is charging me, I don't know, whatever the number happens to be, here's my question. If you're banking with your policy loan, whatever it happens to be, what's the true market rate you should consider giving to your capital? Now, I'm not telling you what to do. You can be your own banker, right? You can pick that number. I put a high value on my capital, and it's typically going to be somewhat higher than what the insurance company is saying that they just want for a policy loan. And Nash says that in the book. He's got this specifically stated in the book that if you're giving a true market value to your capital, not only will you pay the insurance company the interest that you are going to pay them, you said it, you're right, but that extra interest, okay, is going to be that additional premium that we've been talking about in this conversation as well. And that grows the death benefit, grows the cash value, grows the whole thing.
That's right. If you have not read the Nelson Nash Becoming Your Own Banker, you absolutely should. And to answer your question, Rudy, it's actually in this book. It's on what's one in the 50s? Hold on. Oh, I found it. It's on page 53 at the very top. I'll read it so you can understand that our answer we didn't just make up. It came out of the book, okay?
Right.
So this is after page 53 means he's done some things on 52 straight pages. So.
Elena's already saying, don't steal the peas.
There you go, Elena. I love it. Okay, so I'm on page 53. So there's all these pages that he already did stuff. So let me summarize for you. In this example, he has a policy. He has funded the policy. He's paid premium into it. And now he's going to take a loan out of it. And now he's talking about should I repay or not, right? And here's what he says. So examine illustration 2 closely. Notice year 5, column 1, and you'll see $34,600 expressed as an outlay. That's shorthand for the fact that I borrowed $52,600 and paid back $18,000 or $150 per month. Or sorry, $1,500 per month. Notice that the debt, the loan, is being reduced to 0 at the end of 4 years. Remember that the policy loan provision, the insurance company is charging 8%, but I'm repaying my policy at a rate a bit over 15%. That's what Jesse just said, right? They're charging me something, but I'm doing more. It should be obvious that I will repay the loan before the 4 years are up. The additional $1,500 per month becomes additional premiums and adds to the capital base. Right?
Death benefit.
Now we explained it in today's terminology as opposed to using all the fancy insurance jargon, but exactly what we've explained is exactly what it says in the book. You pay your premiums, you take loans. The insurance company's going to charge you some interest, sure, but we are going to repay over and above that. We want to. It adds to our policy as additional premiums, and everything rises. Death benefit goes up, cash value goes up, the amount you can loan yourself goes up, everything goes up, dividend goes up, everything goes up.
And I can appreciate people like Rudy making that clarification for the benefit of everyone, that when you borrow from the insurance company, you're paying them policy loan interest back. But I do still like the language of pay yourself interest. And here's why. Who controls that whole process? The policy owner. So is it you yourself doing that because you choose to? Yeah. And that's why I like the language, because it brings us back to you being your own banker.
There you go. Mike, let's see. Mike C. Floyd said he's confused about all of this. Where can he go to get some more info?
Yeah, right up there. If
you
you'll
go.
click on our icon there in the top left, it'll lead you to our regular page. On the regular page is a video. You can watch the same information that Jonah and I saw going on a decade ago.
Yep.
In a nice, beautiful video. There'll be some handsome guys in that video, right, explaining the nuts and bolts, the introduction to this whole process. That is the place I'd encourage you to start. And then next is you could go ahead and get a hold of this book.
Yeah,
for sure.
The book is about $20 on Amazon. If you click on the link in our profile, you can get a copy of it. I'd encourage you to read it. It's a little bit technical at the beginning, but if you read it, you'll get the idea. I'm not saying you're going to understand all 92 pages, but I am going to say you're going to get the idea. And then generally what we encourage everybody to do is just reach out to us. All of our profiles have our calendar on there. So just reach out to us and we'll talk and walk you through it. So you don't have to be confused if you don't want to be. Mike?
I got a question for you, Jonah.
Okay, I'm ready.
Because it occurs to me.
We'll come back to you, Rudy. We're coming.
All right, we're coming. Yep, just a quick question, but you made me curious. All right, so out of the book, if you could only pick one half as your favorite, front half, back half, I think I know the answer.
Good question. It might not be the answer you were thinking.
And that's why I'd like to know. I'd like to know.
I truly think that I would pick front half. And the reason I'd pick front half is because the front half of the book conceptualizes the idea of what being a banker is, of what you need to learn and unlearn. And that actually is the hardest part for me. The numbers and what happened and what he did is not actually the hardest part for me. Like I can follow it pretty well. And again, this is like just having a little bit of a background in financial services, right? I was a banker at a real bank and did insurance for a while. I keep talking about car insurance and home insurance. Like, so I knew some of that stuff, but I didn't understand like don't steal the peas. That's a big, I still struggle with don't steal the peas. I still struggle with it because here's the thing, right? I've got, you guys know, we're a business. We teach people infinite bankings. That means I have cash compound shirts. And I think that's really cool if my little kids wear them. But don't steal the peas means I should buy them from my business and I should pay more than I charge you for them.
Mm-hmm.
And it's hard to get. It's hard to. I understand the concept.
Yep.
It's hard to be like, no, I should. That is what I should do, right?
Yep.
And then I've got a brother who owns a bunch of coffee shops. I recently reached out and I was like, I want some of his merch. I want to wear like the stuff. And he's, I'll give you a discount. And I thought to myself, I will not give you a discount on my stuff.
Right.
In fact,
That's the captive. That's the captive
in
customer.
fact, I will probably charge you more.
Yeah. That's so good.
And
But you wouldn't have thought that way before
I would
reading that.
never have thought that way. You always get a discount. If your people own the store, if it's your shirt, you're like, just throw me one, man.
Right.
Right? I
Right.
don't even have to pay.
See there, that's why I am
It's
so glad that
interesting.
I asked that question, because I probably I did assume that you would have related more to the second half of the book, because you are so, and that's what I appreciate about you, analytical thinker. But I also understand, and I would have said that first half, for the conceptual reasons that you mentioned, is also my favorite if I had to pick.
Yeah,
So,
it's just really
neat.
interesting to learn that stuff and like, oh, that is true. Like I totally should think this way or not think this way. And
Right.
like that's backward from what I normally do. It's really interesting.
cool. I'm glad I asked.
Okay, here we go. Rudy, again here. Do the dividends get paid directly to the holder, or is that how they provide cash value?
They can be.
Good question.
You get to choose. You get to elect that, and you could change it over time. How we default set up policies and what we'd recommend and what we personally do is we have our dividends each year when we receive those buy more paid up additional insurance, Rudy. Those dividends, once they are paid, it's guaranteed, it's locked in, we have it. And that can grow and compound over a lifetime receiving those dividends, right? And if those dividends buy more death benefit, then that inherently means that the cash value goes up as well, which just grows and compounds the system more. Now, you could get a check in the mail. You could reduce your premiums by whatever the dividend amount. You got lots of options even beyond those.
Yep.
But we recommend buying more paid up insurance.
There you go. I love that answer. Okay, we've got a user with a bunch of numbers in our chat here on social, and they keep saying, beware of anyone who says, be your own bank. You should buy term, invest the difference. They came back and said, VOO performs better than any IUL. I don't know anything about VOOs or IUL. Well, I know a lot about them, but I don't use them, so no big deal. But here's my question for that user, if you're still out there. I brought this up at the beginning. I'm so glad he said it. But you mentioned buy term. I'm not picking on you. Serious question. I'd love for you to respond if you're still out there. You said buy term and invest the difference. That is a very common saying for the people in or around life insurance.
Mm-hmm.
There's even financial gurus who say that's the advice. That's the only advice you need for life
Always.
insurance. Right?
Always.
Applies to everyone. But here's my question for you, user out there. Why does buy term and invest the difference? Like, let's take the concept of that idea. Term is less expensive than whole when you're looking at cost. If it's just life insurance, take the cheaper one and then invest the difference of all the money you saved. My question for you, user, is why doesn't that same concept not apply in other areas of your life?
Don't eat ribeye. Eat sirloin or top round
And invest the difference. Don't own a vehicle. Get rides, rent, Uber, invest the
Lease.
difference.
Yeah.
Don't ever own a house. It is cheaper to rent. Invest the difference. Why does that advice only apply to that one area? That's my question, my real life question. I'd love for you to respond if you're still out there. Let's keep moving.
How about this one?
I'm just
Don't have your own children. Just be an uncle.
Yeah,
I mean, we
invest the
got
difference.
kids, right?
Yeah,
Invest the
it doesn't make any sense. Anyway, okay, Mike said, thanks. You're welcome, Mike. No problem. Okay, Trader Mike. Trader Mike says, is it common to have a fee when making a PUA, such as 6%? So maybe he's talking about like a PUA load.
That's what it sounds like. That's
Okay.
what I had pop into my mind.
Cool. We can answer that, Trader Mike.
Yeah, so everything has a cost to it, right? Everything has a cost to it. What I like about whole life insurance is that the premium is the premium, and that premium takes care of everything. You follow me on that? The premium is level. The premium is guaranteed. When we do a policy walkthrough with our clients, when you've been approved and we're going through that policy illustration together, we're going to point that out to you.
Yep.
That's a guarantee. That premium is level, doesn't go up. So, yes, there are costs to getting this guaranteed contract, right? And I'm not so familiar on the minutia of that because honestly, as a consumer myself, right, like me as a consumer, professional aside for a moment, I don't care. I just want to be banking with my policy, right? I'm interested in the premiums that I'm paying back loans when it makes sense, paying back that market rate of interest like we were just talking about to grow and scale my system, and then buying more policies to be able to do the same and more and quicker and sooner, right? So I want to give you a consumer perspective as well. Like I was a consumer before I was a professional, and that's where I'm at as a consumer.
Cool. I can give you the professional answer, just the other aspect, the other side of the coin to what Jesse said. And the answer to your question, Trader Mike, is yes, it is common, but it's actually not a fee. So a fee, if your mind's thinking fee, you think that I lost the money and I'm not getting it back, and it's not a fee. They actually call it a PUA load, and the reason they call it that as opposed to like a fee is just because you're not actually losing it. They're just not giving it to you right now. So it works a little differently. We can jump into more detail if you end up getting on our call calendar or something like that. I'm happy to talk you through it. But yes, it's common. It's not a fee, though. It's a load, which means you just don't get it now. You'll get it later. There's more to it. But
these insurance companies are very conservative. They've been around a long time. They've been profitable a long time. They know what they're doing when it comes to that kind of stuff, right? To be able to operate as profitably and as long as they have.
Yep. Jake Dosser says The Richest Man in Babylon is a great book to help you understand how you can use your policy to grow your wealth.
Have you read that one?
Agree. Yeah, of course. Richest Man in Babylon, of course.
You say, of course.
Napoleon Hill,
curious.
right?
No.
Richest Man in Babylon
No.
Is not Napoleon
Clayson.
Hill. Who?
Clayson. I'm drawing a blank on his first name, but Clayson. You're thinking of Think and Grow Rich.
Yeah, but I was thinking of
but you've probably read both. I was
thinking of the cover. I thought The Richest Man in Babylon, it's like a smaller book. It's like grayish. Richest Man. So I just.
Well, it's been around so long that there's multiple editions.
Yeah. Okay. I got the author wrong, but I have had that.
So I'll tell you what. Jake. I'm right at the point to where that's one that's getting close to the top of my list for our children. Our children are actually old enough that, and we're not ready for becoming your own banker. They're not that old, right? But they are old enough where I've thought about that book as well. I've read it, and I'd like to read it to the kiddos.
George Samuel Clayton. There you go. Thanks, Keon. So the crazy part about this that I missed Clayson. There we go. I see it. The craziest part about this that I missed the author is that it's probably like 15 feet that
out
way.
on the shelf right there. Yeah, it's a good read. I enjoyed that one. I appreciate, and I love hearing other people's books that have been impactful to them.
Yep, very cool. Okay, aloha from Hawaii.
What's up?
Akara Tantra. What's up? Humble Boy Noel, I live in the Caribbean. How can it work for me?
I was still on the aloha. I was going to say I've got a client that's just been approved, and we're getting ready to get that policy going this Friday. So. And
then Mike said he wants to screenshot the book. Go ahead, Mike.
Yeah, do that.
Right here, Becoming Your Own Banker, 5th edition. If you're still out there, screenshot that guy. Or shoot us a DM. As soon as I get off this, Mike, if you shoot me a DM, I'll just respond to you. I'll send you a link or something if you want to. But there's your book if you want a screenshot. Okay, let's see.
I didn't even pay attention, but I should have. Keon. Of course, you were the guy that knew the book we were talking about. Of course you knew.
I love it.
He's got a big library behind him when we've been on Zoom calls.
All right, very good. Okay, I'm not seeing any unanswered questions right this second.
Oh, man, we're keeping
we got
up.
to thank you, though, for Trader Mike. You're
welcome.
You're welcome, sir. Okay, Elena, Keon, anything? Again, we want to give you a little bit of preferential treatment because you are in our Zoom audience. We had some more in the Zoom audience, but I guess they had to run. No big deal. For all of you guys on TikTok, we go live Thursdays at 3:30. It's not always on TikTok, though. We always do it on YouTube and in Zoom. And so if you actually want to be a part of that, again, just send me a DM. And as soon as this is done, I will I'll hit you and tag you, and I'll make sure that you get the link. So that way we can go. Okay, just scrolling. Do you guys recommend traditional whole life or IUL for BYOB? And Humble Boy Noel, should I get the book? Humble Boy Noel, yes. Get the book, please. $20. It's on Amazon. But just scrolling. Do we recommend traditional whole life or IUL for BYOB?
Whole life.
Whole life. Only whole life. Always whole life. If you read this book, it says whole life. it says you can't do it with IUL. It says a lot of things, but it also says you can't do it with
practice what we
IUL.
preach. Yeah.
Yeah. Whole life. Good question. We can go into more detail if you want more detail, but if that's fine, just scrolling. Whole life. Cool. What else we got? Okay, we are 10 minutes early so far. I want to make sure we get all the questions. Go back up here to YouTube.
Yep, still
Anything
been
up
good
there?
there. Appreciate you
Okay.
commenting, Jake, and asking questions.
Go back up here. I hear you. Thank you. Okay, no problem. Just scrolling.
Mimi, you've been here 4
Mike
weeks
says,
or
do
so
go
in a
into
row.
detail.
go
Abundant
into
Legacy says you can do it with IULs. Oh, my fault. You can go ahead and screenshot it. Humble boy Noel. Abundant Legacy Builders. You cannot do infinite banking with IUL. You can get IUL policies. You can set up IUL policies to have cash value. They work differently than whole life, but if you are interested in the infinite banking concept, you cannot do it with IUL. I'll go into detail in just a second. Let me make sure I get the question that was right above from Jennifer. Jennifer says, I have term life insurance. You're telling me I should borrow money from my policy. Jesse?
Jonah? No, I'm just kidding. I'm just kidding.
Jennifer, the answer to that question is unfortunately no. Your term life insurance policy does not have any money in it. Term life insurance does not generate any cash value. It is very similar to renting as opposed to owning. Like think of a house. Renting an apartment, owning a house. One of them builds equity, one of them doesn't. It just doesn't, right? Renting is renting. That's how you get term insurance. You're going to pick a term, 10 years, 20 years, 30 years. You're going to have it for that term. When it's done, it's done. That was it. That was the deal. Whole life builds cash value. It's actually equity value of the future payout, which is why it builds. But so no, we're not saying go get money out of your term life insurance policy. You cannot do that. There's no money in there. Want to keep going?
I mean, we can. That was good. I'm focused in on that last part of borrow from, but I don't think we need to go there on a term. I see that language and I want to say something about that. You don't actually borrow from a policy. You borrow against a policy for those that are interested.
Sure. Okay, we got lots of new comments coming in here right at the end. We've got Scott. Insurance is an income replacement. No, it is not. Buy term and invest the rest. Stop paying insurance companies money. So he says two things. He says, first, insurance is an income replacement. I've got thoughts about that, but I want to give Scott the question I gave earlier, if that's fine.
Ask him.
I'm really interested in somebody giving some feedback.
Me too.
Okay, Scott, so here's the question we'd like to ask you. Serious question. I'm not trying to step on your toes at all. The question is, buy term and invest the difference. The idea behind that is if all you're trying to get is life insurance, get the least expensive one and then invest the rest of the difference. Invest the rest of it. That's the whole idea behind it. My question for you, Scott, please answer if you can, is why doesn't that advice, get the least expensive option, invest the difference, apply to other areas of your life? Like...
But I mean, the first one that I thought of was the steak one. It's like, don't buy the ribeye or the New York strip, buy sirloin and invest the difference.
Yeah. Don't buy a house. Always rent, invest the difference. Don't ever get a car. Always get rides, always Uber, invest the difference. Why does that only apply to life insurance? And I think I know the answer, but I want to, I've got a pretty good idea, but I want to see what Scott says if he'll respond to us here. Okay, JMVP33, what splits do you recommend?
No default per se. Everybody's an individual. Everybody's financial footprint is different. Hopefully you're having a conversation with somebody who practices infinite banking themselves, and they're looking to, like we would, build you a, we've hit the limit on the TikTok, they would build you a custom policy. Right? So that split should be reflective of your goals, your plans, your aspirations. So it merits a conversation. And we happen to offer free consultation calls.
Yep. Abundant Legacy Builders is a little upset at us that we said you can't use Index Universal Life for infinite banking. So he's telling us to read, that's just one book. Read other books. Laser Fund. Abundant Legacy Building. We've got plenty of books, man, that we could recommend.
Love to read.
We just love this one. This is kind of like the flagship. This is the original, which is why we like it. We were mentioned in another book a little bit earlier in the live. You might have come in separately or just later where you didn't see the other books that we were talking about. But
For sure.
anyway, okay, we got the user back. Hold on, is this the same user as before? If it is the same user, do you have an answer? Okay, the user says, can you do it with VUL? And we got Nicholas Castillo in the chat backing us up. Whole life is the best infinite banking way. Can you do it with VUL?
I don't own any, never written any, don't recommend it. I wouldn't.
I would not either. I would not either. The thing about the other insurance products that a lot of people don't realize is like the problem with them is in the name of them.
Literally in the words.
VUL stands for variable universal life. Variable. We can go into more detail. I should go into more detail if I'm going to bring that up, right? But the idea here is if we're going to say to Elena's question, like borrow the money, go pay something off, but then you've got your policy where you just borrowed the money from has variable aspects to it. You could get into some serious trouble. The policy can do it itself. You didn't even do it. Right? And it can go into more detail. I do have the details. So these folks are going to eat me alive. I shouldn't have brought it up because now I feel like I feel like I'm not going to get to the other questions.
Well, I like doing like you've done so far too, though, asking questions to other questions because it makes for good conversation. How much variability do you want when you could have guarantees? That's how I look at it. Would I rather have more guarantees or more variability? I'd rather have more guarantees.
Yep. Okay, we got a lot of people in the chat right now going off about VULs and VOOs and IULs. So maybe we should talk about that just to wrap up our show
And
here.
some other book titles.
Uh-oh, are we frozen? They're saying we're frozen. Are we? Hey, somebody in the TikTok, tell us if we're still frozen. If not, well, let's come back to them if we get them. But for right now, let's get Elena's question here and wrap up our hour.
Awesome.
Elena says, what do you recommend for individuals who might be ineligible for whole life due to medical history? Is it still possible to do infinite banking?
Well, thankfully, there's also a page in the book about what if you are uninsured, and we have the same answer, which is just because you, if that's actually the case, and that might not be the case. Some people just think, Jonah, well, I must be uninsurable because.
Yeah.
You might not actually know that. If an insurance company hasn't told you that, we don't know that. So I always say start with yourself no matter what for two reasons. One, because if you're going to do this for banking, why not lead from example, right? The family's going to catch on to what you do because you do it. So just lead by example by being your own banker, by having policies on yourself. And then the other part's real prudent, right? Like it makes sense for me to get policies on me before my children because it's more likely that I leave here first, right? So those are two good reasons to me. But just because you are uninsurable, if an insurance company tells you for whatever reason you are certifiably uninsurable, doesn't mean that you can't own a policy.
That's right. I've got 3 children, 6, 4, and 1. I own policies on them, which means I did not have to do the health exam in order to get those policies. Those policies are on my kids. Believe it or not, a lot of times kids under 18 don't have to jump through anywhere close to the hoops that an adult has to. So it even sometimes is a little easier to get policies on other folks. So yes, you can absolutely still do IBC even if you can't get the policy yourself.
Yep.
Cool.
Yeah.
All right, Jesse, I think we're going to call it right there.
We'll keep reading your books.
4:29. We are 1 minute early. We'll give you that 1 minute back. Enjoy your rest of your day. Join us, please, next week right here, 3:30 Eastern Time, Thursday afternoon. We'll pick some new platforms. We'll jump on the YouTubes, the Zooms. But again, preferential treatment to our Zoom audience. So if you're out there watching and you want to jump in our Zoom so we can make sure we get all of your questions, please do. We can send you links. We can help you. Thank you so much, Elena and Keon, for being active in our Zoom audience here. We really appreciate you. Give us a call if you need us. I know that at least Elena's in process.
Yep. Keon too.
Keon
been
too.
approved.
I love it.
And if you want to pick up the conversation, we'll be in our Facebook group, Infinite Bankers.
That's right. We'll be there. But thank you guys so much. Enjoy the rest of your afternoon. We'll see you next time.
Take care.